And you can follow us on Instagram, where we'll put up an exciting post this week, right, Shani? So I have Shani and Emily in the room today because today Emily's new. She started in December because we are officially back in the office. But anyway, let's get started. So my name is Mark LaMonica. I look after the individual investor team for Morningstar here in Australia. And today we're going to talk about how to prepare your portfolio for retirement, which hopefully should be an interesting topic. I hear all the time from Shani, not Emily yet, how much she wants to retire. So she'll be taking a lot of notes during this. But we do need to go through our housekeeping items. Number one, anything you hear today is general advice. Don't know anything about you, so I can't offer personal advice. If you're over in New Zealand, you can get a copy of our FAP from our website, morningstar.com.au. And the regulatory authorities encourage you to speak to a financial advisor for personal advice. Also, we will send out a copy of this presentation and a copy of the webinar, which is available on YouTube with all the rest of our webinars as soon as this is done. Okay. Retirement. I don't know why anything on my computer is doing anything it wants. So this is the last of an 8-part series, which is exciting because we made it through. And we will start a new series of webinars next week, where we've got a couple going on, and then dive right back into another couple series. So tune in for that. We'll cover 4 different items today: the risk face of the retirement, how to mitigate retirement risk, and then a couple different concepts to do that. And Shani just sent me a message saying that I should say hello to my mother. So hello, mother. All right. So let's talk a little bit about, and this is a repeat from the earlier presentation that we did, where we were looking at risks faced with retirement. So we just want to frame this so we can understand what are the different strategies we can use as we move into retirement to, of course, mitigate these risks. So once again, you are facing 2 main risks in retirement. And as you transition to retirement, you're facing sequencing risk and longevity risk. So as a reminder, sequencing risk is the risk that basically you have bad luck, so that when you retire, right before you retire or right after you retire, in that first period of retirement, the market tanks. Now, why is this bad? It is bad because, unlike an investor with a long time horizon until retirement, you are actually selling investments in order to fund the withdrawals that will pay for your life. So if you start doing that after the market has fallen significantly, number one, you are selling more of your assets in order to fund the same amount for your withdrawal. And number two, when the market does go back up, as it has historically done after every one of these bear markets, you will have less assets to take advantage of those gains. So this can have very significant impacts to your overall portfolio value as we get further along in your retirement. So if you can avoid that bad luck and retire at a time when markets are going up, and during the early part of your retirement, if you don't have one of these huge down markets, you're in very, very good shape. The other risk, of course, is longevity risk. So longevity risk is simply that you will die. You'll run out of money before you die, which is not good. And of course, the key associated with longevity risk is the fact you don't know when you're going to die. All right, so let's look at what you do about these 2 risks. So once again, this is a repeat slide, but I think it will frame our conversation today. All right, so longevity risk stems from the fact that there is uncertainty about when you're going to die, right? So it's very easy. If you knew the day you were going to die, it's simple. You have X amount of dollars, you divide it by the number of years you have left in your life, and there you go. You're not going to run out of money. The approach that we want to take with longevity risk, and really the risk that we're talking about here, is that you happen to live a very long time, right? Because we have actuarial tables that will tell you when the average person dies. And when the average person dies at every age, you've seen these stats. If you make it to 65, you have an average lifespan of X amount of years. We have all that data. The problem, of course, is that's average. So that helps us if we are planning retirement for a very large group of people. That does not help us if we're planning our own retirement, because if we are one of those outliers, then we could be in trouble. Then we could run out of money. So what do? Well, what you do is you make sure that you do not go too defensive in the way that you're investing. So we want, once again, as investors, we exchange risk for return. And the risk we're talking about is volatility. So your portfolio going up and down. So once again, that's the risk early in retirement that you're trying to avoid. And you take on that risk to get more return from growth assets. If you have more growth assets, your portfolio will last longer, but there'll be that volatility. So that's sort of the trade-off. So longevity risk, you combat that by more growth assets. Problem is sequencing risk, the risk that you can have down years, that you can have extreme volatility right around when you retire, right after you retire. The way we mitigate that is we do it with more defensive assets. So they have lower long-term expected returns, but they bounce around less. So what you're probably figuring out here is the problem that we face as we plan for and go into retirement is the two main risks you were faced with. You literally need to do the exact opposite things in order to deal with those risks. So that's the issue we run into. And that's what we are trying to solve with transitioning our portfolio into retirement. Okay. So let's talk about both these once again, and let's talk about theory and practice. When we speak about theory around withdrawal rates from a portfolio, we are looking at the overall portfolio like we are selling a little bit of everything. So that means that we will lower the volatility of our overall portfolio with more defensive assets. And when we fund a withdrawal, we will just sell a little bit of everything in our portfolio. And that is a fine theory. But in practice, the key to managing volatility is that you do not want to sell when markets are down. You want to wait till they actually when they rebound. But the problem, of course, is then how do you support yourself with the withdrawal rate? How do you actually withdraw money from your portfolio to pay for your life? That's why we don't care as much about volatility when we're younger, because it doesn't matter. You're not selling. If you've invested in superannuation, you literally cannot touch it. Obviously, a few exceptions until you're 65. It doesn't matter what the portfolio does when you're 40 or 50 because you're not selling when markets are low. You're not being forced into that situation. How do we actually solve that? All right. So we're going to look at two different approaches today. And basically the way that we stop ourselves from selling during a market dip, right? So that's the problem that we're trying to solve is number one, is there a non-portfolio source of funds? And we'll talk about a couple of things around that. And then how can we get funds out of our portfolio without actually selling off the assets that have gone down? Okay, so let's talk about both of these. What is a non-portfolio source of funds? Well, a perfect one would be the age pension, of course. The other option, of course, that a lot of people go through is they just keep working. People understand this risk, and if they have the bad luck, a couple of years before they're about to retire and markets fall, they will just work a little longer and hope that they can get through a recovery by continuing to work. So for some people, this is an option. For some other people, it certainly is not. A non-portfolio source of funds, another approach would be buying an annuity. So if you wanted to buy an annuity with a portion of your portfolio that could fund your basic expenses, and then if you had the bad luck to retire into a bear market, so annuity, in many ways acts very similar to what the age pension is. You're going to get a set amount no matter what. That is locked in. That allows you, if you can live off of that, even if you're cutting back some non-essential expenses until the market recovers, that allows you to get through that period. So, those are a couple options right there. But we're going to talk about source funds from your portfolio without selling off your assets. We're going to talk about two different approaches. And first one with a little top hat, because you generally have to be fairly wealthy to do this. And this is sort of an old school saying that I put in there, is never invade your principal. And I, of course, spell principal wrong there. Should be Ellie. But anyway, what does that actually mean? It basically means that we do not sell off our principal being the assets in our portfolio, bonds, shares, et cetera, and we live off the income. And this is sort of the quote unquote perfect approach to retirement planning. And there are some risks that we'll talk about, but what it basically means is that your assets are there to generate income, just like any other assets, just like if you had your own business and it was generating income for you. And so you really do not want to get rid of those assets, even if the income that's generated fluctuates a little bit. If you do not sell off your assets, you are not degrading the income earning potential of your portfolio. So that's basically that approach, and we'll talk some more about it. Then there's the bucket method, or the bucket concept. So it's basically anchored on this premise that you can fund your near-term expenses with a cash bucket, and then other buckets in your portfolio, and we'll go through the details, can support you in those longer-term issues that you have that you're trying to deal with, like longevity risk. So we'll talk a little bit about how this works, but what it means is you don't have to sell anything because you have this cash bucket that can support you. Those are the two approaches we are going to take today. And I'll talk a little bit about this. You can combine them as well. So there are some ways that you can combine them. Lisa's saying that, well, now I'm getting all sorts of messages about principal. Okay, Lisa's saying I was correct, which is a surprise. And Shani is saying that she changed it in the presentation because I was wrong in the first place. So a lot of things going on here. Okay, so let's talk about this never invade your principal, but Shani, you didn't change it on this slide. Okay, she's rolling her eyes at me. A lot of inconsistency, Shani. All right, so let's talk about how this would actually work. So you invest your portfolio, dividend paying shares or fixed interest or anything else that can generate income. The income that's generated by your portfolio then, of course, supports withdrawals. So you are not selling off your principal there. And that means that volatility in the value of your principal matters less, right? So you're very concerned with, obviously, the companies you're investing in, the bonds you're investing in, to make sure that they continue to pay income. But we just know from time to time, there'll be fluctuations that really are driven by things that potentially are outside of the individual company that you're invested in and matter less. So what are the two issues with doing this? So number one is that this takes a lot more money. That's what this little top hat was for. I was trying to find the Monopoly man, but that was unavailable in PowerPoint. So what is the issue here? That generally when we talk about withdrawals, we talked about this in the first one. We talked about a 4% rule. We talked about how Morningstar believes that withdrawal percentage should perhaps be a little bit less, 3.3% rule, given where we are from a valuation perspective and interest rate perspective right now. But either way, it's difficult to generate that just out of income, out of your portfolio, because of where dividend yields are right now and because of where interest rate yields are. So of course, what does that mean? It means you need a lot more money to accomplish this goal. So I took a quick look. So the ASX 200 is currently yielding around 3.5%. The S&P 500 is 1.5%. So these are historically pretty low compared to what they have been. So that's obviously the market valuation is higher, yields are lower. So it means it could be difficult for you to, we're just going crazy. I'll blame that on my computer. So it could be very difficult to have a portfolio generate that income unless you had a lot larger portfolio. Now, there are certainly some different individual shares, some different types of assets like hybrids, for example, where you can get higher yields, but we have to be very careful that we're not taking on too much risk. And the risk, of course, in this case, is the fact that we are investing in non-sustainable dividend yields. Because that means that, of course, if the income is cut, then we could have a problem because that's funding our withdrawals. Okay. Lots of stuff is happening here. I'll just ignore the chat for a while. The other issue that you have here is dividend income can fluctuate widely. So during the same periods that you see market volatility, you can have dividends be cut. A dividend, of course, is not a guarantee. It's not any sort of contractual obligation. It can be cut at the whim of management of a company. And also, obviously, when market conditions make it difficult for a company to pay that out. So the interesting thing, and I know I'm going to get 50 messages about franking credits, but the interesting thing here is obviously you see that the Australian market is right now and has traditionally yielded a higher dividend yield than the US market and other markets around the world. The only thing I would say about that is that Australian dividends tend to be more volatile. So in the US, a company will not cut their dividend unless something really goes wrong. Whereas in Australia, often dividends follow market cycles. The payout rates are higher in Australia, so a higher amount of earnings are paid out in dividends. So there's less buffer as economic conditions change. So that's just one thing I'll add. And yes, franking credits can get added on top of that, depending upon your tax situation. But either way, you do see dividend income fluctuate a lot. And the GFC was a really good example of that. And a lot of that was because of the companies that were hurt during the GFC. So financials generally pay high dividends, certainly in Australia, also in the US. So during the GFC, when there were concerns about the stability of banks, a lot of regulators came out and said the banks can't pay dividends. You certainly saw that in the US for very long periods of time until they built up more of a capital cushion. So that's why the GFC was a particularly big drop. So the S&P 500 dividend level dropped by 25%. So that can be pretty devastating to you as a retiree, because that means if you're just funding things from your withdrawals, funding your life with your withdrawals, that means your lifestyle would drop by 25%. In other market events like the 2000.com crash, we saw less of an impact on dividends, but only because the types of shares that were doing very poorly, both from a just financial situation and then also from a share price situation, tended to be companies that didn't pay dividends because a lot of it was technology sector. But anyway, every single bear market is different, but just know that dividends can fluctuate a lot. So that is a risk. All right, a good question. We've got a couple good questions. Well, one question by Rachel. So I'm sorry. So the email sent out today was selecting the right investments and building a portfolio in 2022. So that was the overall series, Rachel. So I'm sorry if that was confusing. We did fix the name for the next one. So it wasn't just today's topic, but if you send me an email, Rachel, I can send you a link to YouTube and you can see the whole rest of the series if you would like. There are a couple of them that are very specific around selecting stocks and ETFs, et cetera. So I'm sorry about that. So Lisa of Alpaca fame, who gave Shawnee, believe in the chat, what should give you a 9 out of 10, which is pretty good, better than I ever did in school. And yeah, Shawnee's complaining that English is her second language. Okay, well, that's good. We'll just stay out of that one. So Lisa's saying, so are we saying it's important to balance defensive and growth assets, try to mitigate longevity and sequencing? Is there one more important than the other? So that's what we are saying. Traditionally, Lisa, what we're trying to focus on is our asset allocation and try to get that mix correct between growth and defensive assets. But I guess what we're trying to talk about today is, are there other ways to do that? Because getting that mix is very difficult, just like getting a withdrawal rate perfect is very difficult, because once again, there's so many unknowns out there. So hopefully we'll come up with a couple different ways in a more practical sense, not a theoretical sense, that we can manage this. So Rodney says, doesn't never invade your principle go against the total return concept? You could just as easily invest in growth businesses instead of dividend shares and sell down to generate income. 100%. So let's talk a little bit about what Rodney is saying. If you talk to many professional investors, they will tell you the concept of dividends is ridiculous and that we should not be investing for dividends because, once again, we are focused on total return, meaning that we can sell off shares or we can collect income and it doesn't matter. And particularly many professional investors will tell you that dividends are really tax inefficient ways of providing shareholder returns, and that buybacks are better. So let's spend a second talking about this and then why I have some issues with it. So what happens when a dividend is paid? Well, a dividend will generate taxes. Now, in Australia, there is a mechanism to ensure that taxes are only paid once. So the theory, of course, is that you own a company because you own just a part of it, but you own a company. The company that you own should not pay taxes. And then you pay taxes at double taxation, right? Just like if you owned a small business, you shouldn't pay taxes when your small business takes money out, earns a profit, and then when you take money out, because you are the sole proprietor of that small business. So that is the theory behind franking credits, that you are eliminating that double taxation. So as a taxpayer, you are getting credit for the taxes that have been paid by a company you own. But either way, you're paying taxes. So in many countries, like if you go to the US, while dividend taxes are lower than what your marginal income tax rate is, while they're lower, you're still taxed twice. Companies taxed and you're taxed when you receive the income. So regardless of franking credits, any different political systems, either way, taxes are paid. Buybacks in general do not have this problem. So what is a buyback? A buyback is when a company will take money, company earns money, they can do whatever they want with it. They'll take it and they'll buy back shares. And by buying back shares, it reduces the share count that's actually out on the market. That benefits you as a shareholder if you hold on to the company because you own a higher percentage of the company. It benefits you if you are somebody who wants to sell because there's more of a market out there to buy shares and it's propping the price up. So people will argue that it is more tax efficient to use a buyback. The couple problems I have with that, Rodney, are number one, it assumes that management is making a good decision, a good capital allocation decision. Buybacks can often be used to cover up compensation for people who work at the company. So in order to offset the dilution that occurs from giving shares to employees of the company as part of their compensation, and there can be really good reasons to do that, the company will go out there and buy back shares. So when you go and you look at a lot of these technology companies that have these huge buybacks, billions and billions and billions of dollars, then you go and you look at the share count over time, it doesn't change that much. So those are companies that are literally just covering up dilution of their dilution of shares by issuing more shares to employees, options, or just direct grants. They're covering that up with these huge share buybacks. So it's something that plays very well in the press. We're announcing this huge share buyback, but you're not really getting any of the benefits of that. And what they're kind of doing in a way by giving shares away is they are sort of hiding some of that compensation. They're not actually hiding it in any real way, but it is an expense, right? So yeah, I mean, I think that is one of the concerns around this. The other thing is I would say dividends keep companies honest. So the expectation that you are going to pay a dividend means that management, of course, has less money to invest in the company, and they will have a little higher hurdle rate. So the most important thing a company can do is make sure that it's earning a good return on what it invests in the company. So yeah, those are some of the arguments. So I'm personally more on the dividend side of things. I think dividends are good. I invest for dividends. But yes, sort of investing theory says that it's inefficient and that who cares whether I get a dividend or I sell off some of my shares. So June says, I absolutely disagree that dividends are an inefficient way to return funds to shareholders. I never participate in buybacks in our self-managed super fund. Realistically, if we bought the shares to hold long-term for our goals, why would we then sell? Never do anything solely for tax purposes. Yeah. The only thing I would add there, June, is, whether you participate in the buyback or not, it's still happening. So the question is, should the company do that or not? So yeah. Anyway, I tend to agree with you more, June, but yeah, thanks for that. Okay, let's move on to the next one. Then we can argue about dividends more later. All right, bucket approach to asset allocation. So the other approach you can take is, once again, looking back on those two problems that we're trying to deal with, sequencing risk and longevity risk, is we divide our portfolio into 2 or 3 buckets, and we'll talk about what these buckets are. And one of those buckets consists of cash. So this cash bucket, and I know what everyone's thinking right now, cash is horrible, you're not getting any interest on it, but the cash bucket protects you from volatility. So if there are extreme swings in the market, you don't sell off any of your shares to fund your retirement. You simply take out of the cash portion, that cash bucket. Those other buckets, and we'll talk about why there could be 2 or 3. In those other buckets, you have assets that replenish the cash bucket when you take money out of it, through either income that's earned or from selling off some of those shares or bonds. And that enables you to focus more on longevity risk in those other 2 buckets. So how would this practically work? Well, you would have this cash bucket if the market was doing great or even just doing fine. You would take out whatever you were drawing that year, and then you would immediately replace it from the other buckets, to ensure that that cash bucket always had a set amount of money into it. The market was doing terribly, you wouldn't replace it. You would wait until the market recovered and you would sell off your assets at a more opportune time. And that way you are not selling during these deep bear markets. And that way you are mitigating the risk, the sequencing risk, basically that you're going to run out of money and you have lower portfolio values. All right, so a couple of things you need to think about is, number one, and we'll go on to a slide next where we look at this, market downturns can last for a very long time. They can probably last longer than your cash bucket, depending upon how much you put in there. We'll talk about that in a second. So that, of course, is your risk, that if I'm just sitting there waiting for markets to recover before I sell anything, what happens if I run out of cash before markets have recovered? Now, obviously, you're still buying yourself time. Each year that you do that is buying yourself time for the market to go back up. And it's also meaning that you're not selling assets every single year. So it's always a good thing, but just be aware that you can run out of your cash bucket. So the big considerations that you need to look at in your cash bucket is how many years worth of withdrawals to keep in the cash bucket. And then what is your asset allocation in the other bucket or buckets? So let's talk about what this means. So sort of the classic bucket approach is that you've got this cash bucket, then you've got a bucket that has more defensive assets. So fixed interest, for example, something's going to get you a little higher return than cash, but still is a defensive asset. And then in that third bucket, you, of course, have growth assets. So whether that's shares or listed property or infrastructure, et cetera. And of course, you need to figure out how much to allocate. So as part of Morningstar Investor, our subscription product, there is 3 different bucket portfolios with suggestions for allocation. But you're still trying to figure out how much to allocate. And once again, if your cash bucket and if bucket number 2 that has more defensive assets, if too much is allocated to that, you're basically getting yourself in that same situation where you could be impacted by longevity risk. And the interesting thing about looking at this is the more years worth of withdrawals that you hold in the cash bucket, of course, the more aggressive you can be with the rest of your portfolio. So that's why I personally, and given the current market environment, why, and I actually do this with my mother, she has 2 buckets. She has a cash bucket, and then she has a share bucket, because I didn't think that right now with bonds and what they're yielding, that there was really much of a point to have that middle bucket. And sort of what I did is I chose to put more money into her cash bucket, and that will, of course, provide her with more time. And then I've been a little more conservative in that share bucket. And what I've done is I've invested in more low volatility shares that pay very high dividends. And so a lot of her cash bucket can actually be filled back up with income every year. Not all of it, but a lot of it. And so when you combine a number of years in the cash bucket, lower volatility, but probably a larger share bucket than most people would recommend given her age, I think it kind of protects against those two risks. We'll see what happens. As I always say to her, I have a lot of incentive to make sure she doesn't run out of money because that will keep her from moving in with me. But we all have our own motivations. All right, so those are the buckets. I can't wait to see what WhatsApp message she sends me after this. All right, so Carrie's saying when you go into a buyback, you generally have to sell it at a discount of 10 to 14%. Yeah, I mean, so buybacks are a little bit different in Australia. There are also open market buybacks where literally the company is just out there in the open market buying back shares. They're buying back shares just like anyone else. So if you go into whatever trading account that you use and you're selling shares, you don't know who the buyer is, it could be the company. And then there are these announced buybacks where, yes, there are all sorts of stipulations associated with them, including the price that they're going to buy them back, and you can elect to take part in that buyback or not. So the anonymous attendee says, how does the U.S. deal with double taxation of dividends? Basically, they don't. So what the U.S. does is the U.S. has the tax that you pay on dividends that you earn is taxed at a different level than your income. So you might be paying a 40% tax on your income. Tax that you're paying on your dividends is complicated because it has to do with where you are in tax brackets for dividends. But the sort of the standard for most people pay 15% tax on dividends. Right. So you are getting an incentive, but they are not eliminating that double taxation altogether. So I will say that Australia, I believe, is the only country in the world that has truly eliminated that double taxation of dividends through franking credits. So yeah, it was actually when George W. Bush was president was when that changed. So dividends used to be taxed at your marginal tax rate, income tax rate, and then he reduced it to 15%, acknowledging that there was this double taxation problem, but also not moving it to zero and actually eliminating it. And what that did do is that did sort of coincide with a giant increase in the amount of dividends that U.S. companies paid, because it took away a little bit of this tax inefficient argument that was associated with it. But that also happened during the dot-com bust, where, yeah, all these very speculative companies went down a lot and people were more interested in dividends. Okay, yeah, to answer a question about the U.S. All right, got some comments. Most of them are Lisa and Shani writing to each other. So Lisa's saying dividend reinvestment plans are a great way to build a portfolio while you're in the accumulation phase. Yeah, no, I agree, Lisa. So dividend reinvestment plan simply means that when a dividend is paid to you, instead of taking the cash, you get more shares. And so the advantage of this is, however mathematically you want to look at this, essentially lowering your cost basis on the shares you own. And it's also increasing your income. So there are some very good things about dividend reinvestment plans. I really like them. But yeah, so Simon saying Australia buybacks have a frankable dividend component, essentially based on portion of retained earnings / reserves to total equity. So there may be little tax difference between franked dividends and share buybacks. So the buybacks are usually optional, where dividends go to all shareholders. Yeah. Yeah. So basically, a buyback. So, in many ways, this is kind of the argument that Rodney was making earlier, is that, the advantage of not taking dividends is that I get to choose when a taxable event happens, right? So that if you have a company that pays 0 dividends and a company that pays a 5% yield, every year I know that there will be a taxable event, right? Every year I'm going to get dividends, whether I need the money, whether I don't need the money. That taxable event's going to happen. So I think Rodney's argument, the argument that a lot of people have, is that I get to choose when that taxable event happens because I sell shares. So whether it's a buyback that I choose whether I'm going to participate in or not, or whether I'm just selling my shares into the open market, I get to pick when I pay taxes. So obviously everyone's tax situation is very different, but I think that is the argument there, that instead of the company choosing when I pay taxes, I get to choose when I pay taxes. All right, a really good, or we've got a comment by Lisa. So she has a middle or bond bucket. My middle bucket spreads maturity dates of bonds. So every few years I can cash in a bond at maturity or change it to shares or cash. Okay, so let's talk about what Lisa's doing, which I think is a really good thing to do. When we think about bonds, one of the issues that we run into is I think many people think about bonds the way that Lisa is using them, that I go buy a bond and in a certain amount of years, I will get my money back. And until that time, I, of course, get interest. And that is, of course, the way a bond works. Problem is, it's not really the way an ETF that tracks an index full of bonds works. So in reality, the ETF is always buying new bonds because it's tracking an index, or it could be actively managed, but either way, it's always buying new bonds. There are bonds issued all the time. So governments certainly go out and auction bonds off all the time. So the companies, these indexes are always changing. They're always buying new bonds. They're also obviously having bonds that they own mature. So you don't really get that same relationship with an ETF. An ETF, the value, so Lisa could buy a bond, and no matter what happens with the price, interest rates, basically they're going to drive this, or differences in credit quality, no matter what happens while she holds that bond, she's still going to get her money back unless the bond defaults. So if Lisa has a $100 face value on a bond that matures in 2 years, she knows she's going to get $100. Doesn't matter if 6 months from now her bond is worth $90, because she's not going to sell it. She's going to wait until she gets that $100 back. ETFs don't work that way. So an ETF will respond based on the interest rate risk, or pretending that nobody's defaulting now, but based on the interest rate risk of that basket of securities in there. So in theory, an ETF can just go down and down and down and down in price over time as interest rates go up, right? Because bond prices move inversely to interest rates. So if we are on a steady march up in interest rates, so we know everyone's going to start raising interest rates soon, either have or will, your ETF could continually lose value. And so that is the problem that you run into, not necessarily with the instrument, but with the way the instrument works, the bond being the instrument, when it's in an ETF, when it's basically a portfolio of bonds. So yeah, something to think about with bonds. So Phil says private equity has made finding high quality, high yielding shares harder to find on the ASX and probably other markets. This has forced the total return approach onto pre-retirees. Okay, it's a really, really good comment. So what has happened, if you haven't noticed, private equity firms and super funds have come in and bought up a bunch of utilities and infrastructure, right? So we just saw the bid between Brookfield in Canada and, what's his name, Lassian dude, on AGL. So we just saw that. If that goes away, there are 2 utilities left trading on the ASX. So they've all been bought up in the last couple of years. So if AGL goes away, and the bid was pretty low, at least our analysts think so, so they think it should be raised before AGL would accept it. So if that goes away, you've got 1 utility trading on the ASX. We've seen the same stuff with all these infrastructure companies, right? So we've seen Sydney Airport go down. Like, we keep seeing these sort of infrastructure-like high-yielding securities go away. And why have we seen that? Because what private equity is looking for, and what a lot of these super funds are looking for, these very long dated portfolios, or very long-term investors, are looking for sort of sure signs of cash flow. And that's why they like these companies. And that's why many investors like these companies as well. So they have to take on some debt. They do that to build or buy this asset with a very long life, like an airport. And then they, of course, just collect cash from that airport over a very long time. So yes, these things are disappearing. This is another reason, not just valuation levels, it's another reason that yields are getting lower and lower, because basically it's sort of the traditionally high yielding companies are getting picked off. And one of the reasons the ASX, the yield is still so high, is because number one, the miners have had a really good run. So we'll see if that continues, but that's very contingent, obviously, on commodity prices. So they've been paying a lot of dividends. And of course, the banks. So the banks make up a very large part of the ASX versus other markets. So you do get a higher yield. Then, of course, there's just the propensity for Australian companies to pay dividends because of franking credits and because people like them, right? Companies want investors and want the share price to go up. People like dividends are going to give people dividends. So yeah, Phil, it's a good point. It's a good point. So it'll be interesting to see if we continue to see this happen. There could be less and less of an opportunity, or be harder and harder to create a portfolio that can generate enough income to pay for you. And a good example for that is there always was this little like hedge fund dream of people working at hedge funds that made a lot of money, is like, how do you retire? What's the ultimate way you retire? It used to be, I have a portfolio filled with US Treasury bonds and I live off the interest. So what they're really saying is I have something that is risk-free from a principal standpoint, and I can afford to live off the interest. Now, that was one thing to say when, bonds are yielding 7%. It's a different thing to say when they're yielding 1.5%, right? So we've seen this whole, there is no alternative, this TINA phenomenon when people have, moved into shares because they weren't getting anything out of bonds. And now we're starting to see some of those high income shares go away. All right, the anonymous attendee is saying it's easy to find the history of a share price of a company, but how do you find the history of dividends? All right, well, let's find it together. All right, I'm going to share my screen, which, here we go. Oh, yes, on the first try. Must be my new computer. I haven't had a chance to open as many screens. So, all right, so one thing, so I'm in Morningstar Investor right now, doing something. All right, I'm in Morningstar Investor. So one thing I was saying, these bucket portfolios, you go to track investments, you go to bucket portfolios. We have 3 different ones, aggressive. So remember, these are the allocations: cash bucket, short-term bucket, long-term bucket, which is more shares. So that's one thing to look at. But let me show you how you can do this. We will pick one of the few kind of infrastructure-y companies left in Australia, Transurban Group, that's still public. All right, so if we go on to dividends, here is your history. So basically it shows you a couple different things. Number one, shows you the dividend paid per share, and it'll show you the yield. So we can see with Transurban, for example, the dividend grew for a while, then was cut in 2020, like basically everyone else's dividend. And you can see also how the yield, the dividend yield, has changed over time. It has come down significantly. This is what we're talking about. We used to be able, if we go back to 2012, we had a 5% yield. Now we have less than a 3% yield. 5-year average is higher than current. So we can see that's one of the problems we're facing in the market, right? With higher valuations, you're getting lower dividend yields. And then if you want to see the individual dividend yields, you can go back and open this up. So that can show you the history of the dividend yield. Now, what I would say is, if you look at many Australian companies, they do bounce around a lot more than US companies. And just because there is this different approach to dividends here. So you can get a little more fluctuation. So one thing you can do if you sort of combine these two approaches is, and you're worried about that fluctuation in dividend income, is of course, you can still have a cash bucket. You want this to be your goal, a cash bucket. The cash bucket can either have a couple years worth of dividends sitting in it so that you are not literally getting a dividend and going out and using it to pay for your life, that you have that buffer in there. And that can help you deal with variations in dividend yields. Okay, so the bucket idea is good in theory, but with interest rates almost at 0, you have to take 4% prescribed by the government. It's hard not to sell shares to fund prescribed retirement money. Yeah, so I would say 2 things. You are not, this cash bucket is not meant to earn a return for you. It is supposed to protect you from volatility. So in most years, when the market is bouncing around, or when the market is just sort of either going up a little bit or around even, in most years, you would still be selling. You would still be selling assets. It's only in those years where there is an enormous drop in the market and you want to sort of wait out that recovery. And I've got another slide. Okay. So let's go back and look at the types of drops we are looking at. So these are not, as people point out, these are not all technically bear markets, because you need the market to go down 20% in terms for it to be an official bear market. So officially, all these little 19 whatever percents are not bear markets, but it's the same difference. So what we looked at here is we looked at going back to the early 70s until, and I didn't include the COVID bear market. So there's the COVID bear market after this, but that recovered in like 36 hours. That's an exaggeration, but looked at all the drops in the market, looked at the drawdown. So how far did the market drop? This is the S&P 500, by the way. And then the time to break even. So basically, this is what you want your bucket portfolio to protect you against. And these are in months, obviously. So really, for the most part, we've got these three outliers. This early 70s crash, so that's the Nifty 50 crash. We've got the dot-com crash, and we've got the GFC right here. And so these were sort of the peaks of the market before the fall started. Really, it's these three crashes that would have been the huge issues if you were retiring into. Everything else you probably could have dealt with and it wouldn't have been that big of an issue, particularly these ones. 3-4 months, of course, are easy to deal with. You know, little over a year, a little less than a year and a half. Those you could have dealt with as well, most likely. But these ones are tough, right? The amount of time that it would have taken, 4 years with .com, for example, crash. Those are the ones where it would have been really challenging. And that's what you need to think about from a bucket perspective. That drawdown table is scary, Mark. Okay, I've scared Lisa. Lisa sent me a video of her alpacas getting shorn. It's wool, not fur. I learned that. What was scary was the sounds the alpacas were making while they were getting shaved. Lisa swore that it was because they were ticklish, and this is them laughing, but I have nightmares about the sounds they were making. So don't show the drawdown table to your alpacas. All right, we made it. We're out of questions, which is good. So somewhat similar to the theme, on Thursday, the webinar, we're going to go through income investing. We're going to talk about finding sustainable income in your portfolio. So tune into that. If you don't have the link to sign up, let me know and send me in. I've been reminded of something, and send me in a email. All right, we're going to ask some questions. Remember these poll things. So we are going to ask some questions, see if you learned anything on here. All right. So the first one, why is volatility a bigger risk for people approaching retirement or just in retirement than it is for long-term investors? Let's see if people can answer this. And then I'll feel good that we learned something today. We'll just give everyone a second. See, it's like you're back in school, except for it's probably more boring. I don't know. Shani liked that one. She was going to be very angry at me at the end of this webinar, along with my mother probably. So it's going to be a tough afternoon for me. All right, we will end the poll there. We'll end the poll there, and we will share the results. So it is this second one, drops in portfolio value and withdrawing funds makes it harder to recover losses. And I will say that this was a little bit of a tricky one, this first one. So volatility can cause behavioral risk and can lead to poor decision-making. But we said, why is it a bigger risk for people approaching retirement or just in retirement? This would be a risk for everyone. Thursday's webinar, Phil, is at 1 p.m. All right. Now, okay. I'm not very good at this. We have another question. And I believe we're doing a night webinar next week. Am I Tuesday night? We're doing an earnings season recap Tuesday, 6 p.m. The email has not come out yet, but it will come out. All right, we'll see how people go on this one. And everyone should look for Shawnee's article on earnings season in the ASX newsletter. Shawnee went to Uluru this weekend. She was going to go on a tour where an eating tour of things found in the bush. And then I told her about it and she canceled it. So note to self, don't take Shawnee out to eat in the bush. Okay, what are some downsides to an income funded withdrawal approach to retirement? Yeah, so both A and B. So yeah, it does generally require a bigger portfolio than most set withdrawal strategies. And yes, income can fluctuate significantly. All right, we're almost there. We have one more question. And now I've gotten good at sharing them. So we're all learning things here. All right, what are the advantages to a bucket approach to retirement? And Rodney says your mother's only angry with you because you don't want her to move in with you. Yep, you nailed it. Rodney says witchetty grubs totally taste like peanut butter. Shawnee is not willing to take the risk. You're not willing to take the risk? Imagine if you were the witchetty grub. They're just hanging out and they get dug up so that you can eat them, or in your case, not eat them. What are the advantages to a bucket approach to retirement? Yep, so investors can ride out market volatility by utilizing the cash bucket, not selling investments until the market recovers, I assume. I can't see the rest of that. Yeah, so the protection provided by the cash bucket allows a greater proportion of not defensive assets, but growth assets. All right, so we did it. Wow, we're getting lots of sharing right now. Lisa says crocodile tastes like fish and a bit like chicken. Shawnee should try a witchetty grub burger. It's better than grilled. A lot of opinions about what you should be eating, Shawnee. Shawnee had a bowl of curry for lunch that her mother made her. Anyway, thank you guys very much for joining. We'll be back on Thursday, talk about income investing. And if you have any questions or comments, please send them through email. I'll forward them on to Shawnee if they're food related. Crocodile does taste like chicken, says Rodney.